and welcome to Young and Visionary with me, Esnat Suleiman. In this episode, I will be talking about liquidity on the stock exchange. So what is liquidity? Basically, when we talk about liquidity, it's such a fancy term, but it simply means how easily you can sell or buy shares on the stock exchange. So if some of you have placed an order before, maybe you've had to wait a week, maybe even a month before you could actually buy the shares that you were looking to buy. For some investors, this can be quite frustrating. In this episode, I want to dissect and explain the reasons why shares at some point can be difficult to sell or can even be easy to sell, why they can be easy to buy, or why they can be difficult to buy at certain points in time. So, just like any other commodity, if you were to ask what determines how easy or difficult it is to buy or sell, it is because of the simple law of demand and supply. But there are some underlying factors that affect the demand or the supply of shares on the stock market. So obviously, if there are a lot of people trying to sell, it is very easy for someone to buy. But if there are a lot of people trying to buy, but there are very few people selling, you'll find that the transactions will actually go down. So what causes these fluctuations in demand and supply? The number one thing is the performance of the company or the share that you want to buy. So sometimes the companies will issue what are called trading statements. A trading statement is simply a notification by a company explaining how much it expects its profits to either grow or to decrease. When a company issues a positive trading statement, meaning that it expects its profitability to improve, you find that investors who track the stock market are attracted to buy shares in that company. You will find that there is an increase in demand. You'll find that investors that are already holding the share may not sell the share because the prospects are looking good. Another such notice would be a dividend notice. So when you buy shares, you earn return in the form of a dividend. So a dividend is when a company makes profits and distributes those profits to its shareholders. So what you will find is that if a company announces to say that we're going to pay out a dividend or we're going to distribute our profits, you will find that the shareholders that own shares in the company will unlikely sell the shares because they want to receive that dividend. At that point in time, it may be difficult for new investors to be able to buy those shares. Or there could be just other corporate announcements. Maybe new management has been appointed. Depending on how investors read the information that has been presented by the company, it could create an increase in demand or it could create an increase in supply, which is people trying to sell the shares. The second thing are the number of shares that are in issue. So every company has a certain number of shares that it has allocated to shareholders. Some companies have a lot of shares, other companies have few shares. So if you go and look at the stock market report, there's actually a column that shows the number of shares in issue. What you will tend to see is that companies that have a lot of shares will trade frequently because there are more shares available to be transacted on the stock exchange. Therefore, they are more liquid. So if you look at, for example, the likes of TNM, it has one of the largest number of shares in issue. It is also one of the shares that trades quite frequently. Another thing is the number and nature of shareholders in the company. So the stock exchange actually even regulates the minimum number of shareholders required for a company to list. And the reason it does this is because the more the number of shareholders, the more the likelihood that the shares will actually trade on the market. And also, The stock market also regulates the percentage of shares that are held by the public. This is because the public are more likely to transact the shares than certain class of investors. So if you were to look at individual investors like you and me compared to corporate investors, you'll find that individual investors trade more on the market, small volumes, but the large investors, they trade once in a while. So when a company has a lot of individual investors, there is a lot of trading activity on the stock market from those individual investors. Another reason that affects the liquidity of a stock is actually the investment options available. If we look at our stock market, we only have about 16 listed companies. And then we have the pension funds that are growing. We have individual investors. There's actually a growing middle class that is interested to invest in shares. All of this new money coming in is chasing the very same investments. So what you will find is that there is a buildup of demand, yet the supply remains the same. So this buildup of demand actually has the potential to actually drive demand up, to drive the price up, and also to limit transactions, because now there aren't enough shares to actually be transacted to meet the demand that is actually there. So having said that, what does it mean to investors like you and me when we place orders on the stock market and we're not able to buy the shares within the time frame that we would wish to? I think generally to an investor, you really have only three options. You can either just wait it out, so you wait until the shares become available. I have a personal experience where I had placed an order on the stock market and I was waiting to buy the shares, and the prices happened to go up because, you know, the shares that were available to trade weren't a lot. The demand was high, the price ended up moving while I was waiting to buy. But as an individual investor, sometimes you really don't have a choice but to wait until the shares are available. Another thing that you can actually do is to move the price. So I always say that any share is tradable at the right price. So people can be enticed to sell because you've offered a good price for the shares. And people can be enticed to buy because you are offering to sell the shares at a lower price. So at the right price, you can still buy or sell. So one option that you do have is actually to move the price. I, as an investor, I actually like to just trade at the market price. And while I was waiting, I remember my broker asking, should I move the price? And I was like, no, I'll buy at market. If someone else moves it, well and good, I'll buy at whatever market price that will then become. And then lastly, another option that individuals do actually have is to simply then move on and buy another counter that is more readily available, as long as you've done your research and you feel like that is the counter that you would wish to buy. So that is where we end today's episode. I hope that you continue to follow this channel, invite others to subscribe so that we can have a lot more people who are informed about investment opportunities for a better tomorrow. Good day.